Welcome to the Debt Circle podcast on this fine day. I'm Vijendra.
And I'm Leela. Today we have some exciting updates in the finance world that we're eager to discuss. To start off, PineGap has successfully raised $8 million in their Series A funding, signaling strong investor confidence in their vision. On the currency front, the Indian rupee opened marginally stronger at 95.17 against the US dollar, showing subtle yet positive movement.
And perhaps most intriguing is the latest from the Securities and Exchange Board of India. SEBI is planning a comprehensive revamp of the securities lending and borrowing framework to align with global standards and enhance market integration. Yes, and in addition to that, SEBI is piloting the tokenization of corporate bonds using distributed ledger technology, aiming to boost settlement efficiency and transparency. They're not stopping there. SEBI is also focused on deepening cash equities and commodity derivatives markets, addressing emerging risks like quantum computing, and leveraging AI to improve fraud detection and governance.
It's a transformative agenda that could reshape India's financial markets in profound ways. We have a lot to unpack today. So, let's dive in and explore these developments and what they mean for investors and the market at large.
Pinagap, a Bengaluru-based AI equity research platform, raised $8 million in Series A funding, led by Stellaris Venture Partners. The capital will focus on expanding in the US and enhancing AI research workflows for institutional investors. This funding aligns with growing market demand for AI automation in financial services. Pinagap's customized AI agents help institutional clients reduce routine analysis, improving efficiency in equity research.
They've deployed over 1,000 AI agents across more than 100 institutional clients, generating over 50,000 research reports monthly. Their tech tailors AI to each firm's unique investment process. Such tailored automation enables investment firms to focus on judgment and decision making, a crucial advantage as generative AI adoption accelerates in the financial sector.
Now, let's discuss another important development. The Indian rupee slipped by 8 paise to 95.25 against the US dollar, pressured by a stronger dollar and rising Brent crude oil prices at 84.31 US dollars per barrel. That pressure is typical given India's oil import needs. However, foreign institutional investors bought shares worth rupees 480 crores and forex reserves rose significantly by 10.5 billion US dollars, cushioning the fall.
Market analysts expect exporters to sell rupees up to 95.40, while importers will buy near 95, keeping the rupee range bound between 95.20 and 95.30. Geopolitical tensions in West Asia and Reserve Bank of India's policy signals will be key to currency stability and market sentiment going forward.
Let's move on to our next article. SEBI plans a major revamp of the securities lending and borrowing framework, aiming to align it with global standards and better integrate cash and derivatives markets. This framework, unchanged since 2008, currently limits efficient price discovery and market depth. That's significant for market liquidity. Updating the framework should improve trading efficiency and attract more participants, strengthening both equities and derivative segments in India's capital markets.
Additionally, SEBI will pilot tokenization of corporate bonds using distributed ledger technology. This aims to speed up settlements, enhance transparency, and potentially integrate with central bank digital currency systems for automated processing. Tokenization could revolutionize bond markets by reducing settlement times and operational risks. It also signals SEBI's push towards adopting cutting-edge tech like AI and blockchain to modernize market infrastructure overall.
Here's another significant update. Asset reconstruction companies purchased bad loans worth rupees 26,304 crores in the June quarter, a 56% increase year on year. This surge happens despite the banking sector's gross non-performing asset ratio falling from 2.8% in fiscal year 24 to 1.8% in fiscal year 26. That means banks are offloading legacy stressed assets more aggressively. Even as fresh slippages decline, the market is seeing a clear push to clean up older non-performing assets, which is positive for long-term banking stability despite the headline improvement in asset quality.
Also, transaction structures are shifting. More deals now involve higher cash payments, sometimes the entire purchase price upfront, rather than relying mainly on security receipts. This cash-intensive approach signals evolving market practices in stressed asset resolution. Such changes could improve recovery rates for asset reconstruction companies and encourage more active participation in the stressed asset market, further accelerating the cleanup of bad loans in the banking system.
Let's look at another key development. Steel Exchange India Limited paid rupees 1 crore 53 lakhs 51,042 in monthly interest on its secured non-convertible debentures worth rupees 382.8 crores on August 7th, 2026, right on schedule. Timely payment like this, especially under strict SEBI regulations, signals strong financial discipline and builds investor confidence in their secured debt instruments. The company confirmed no delays or defaults, complying fully with listing obligations, which reassures stakeholders about their operational stability. Despite mixed stock performance recently, this consistent debt servicing shows resilience, important for debt market professionals evaluating credit reliability.
Here's another significant update. The Reserve Bank of India's 2022 rule mandates that Indian residents must deploy funds sent abroad under the liberalized remittance scheme within 180 days, either by investing or spending. This has prompted offshore banks to limit issuing international credit cards despite strong credit histories.
That's significant because these international credit cards avoided currency conversion fees and automatic reporting. Now, banks face compliance risks and regulatory uncertainty, making them cautious, especially with accounts held by minors who cannot easily meet redeployment requirements. Minors holding foreign accounts are particularly affected since they cannot consent to investments, causing banks to withdraw services. The regulatory position on minor remittances hasn't changed, but practical challenges have increased scrutiny. This tightening reflects RBI's focus on preventing misuse of remittance limits.
Let's move on to our next article. NSE Clearing Limited fined Share India Securities 1 lakh rupees plus 18,000 rupees in goods and services tax for breaching the market-wide position limit. The penalty was promptly disclosed on August 7, 2026, reflecting regulatory compliance. Given the total penalty of 1 lakh 18,000 rupees is minor relative to their operations, market impact is negligible. Their stock shows mixed short-term performance but strong 5-year gains, suggesting investor confidence remains intact despite this compliance issue. This isolated penalty is unlikely to affect Share India Securities market standing.
Let's move on to our next article. The State Bank of India posted a net profit of rupees 211.21 billion for Q1, up 10.2% year on year, beating estimates of rupees 191.02 billion. Loan growth was strong at 18.63%. That loan growth is impressive, especially with deposits rising nearly 10%. The domestic net interest margin improved by 7 basis points to 3%, unlike other major banks that saw margin declines this quarter.
Asset quality improved with gross non-performing assets down to 1.47% from 1.49% last quarter. However, slippages rose to 70.46 billion rupees but remain below 1.49%, 0.46 billion but remain below last year's 79.45 billion. SBI also mobilized $6 billion in subsidized foreign currency deposits under the Reserve Bank of India's swap facility, targeting $10 billion total, showing strong foreign currency inflows supporting the banking system.
Let's look at another key development. Large microfinance companies like Muthoot Microfinance and Satin Credit Care have raised their growth targets to between 20 and 25%, responding to a 12% contraction in private banks' microfinance portfolios, which shrank from rupees 89,548 crores to rupees 79,023 crores. This shift means larger NBFC microfinance institutions are consolidating their market share as smaller lenders pull back. Muthoot Microfinance increased its advance growth guidance from 12 to 15% earlier up to 20%, while Satin Credit Care moved from 15 to 20% up to 25%, filling funding gaps left by smaller MFIs struggling with limited bank access. With the sector showing improved asset quality and stricter lending norms, larger NBFC MFIs like Credit Access Grameen expect stronger growth in the third and fourth quarters, traditionally the busiest periods, despite risks like irregular rainfall impacting earlier performance. Moving to our next story. Indian government bonds gained this week, reversing 5 weeks of losses. The 6.94% bond maturing in 2036 closed at a yield of 6.7651%, down 7 basis points for the week. This was driven by a dovish Reserve Bank of India stance and a significant drop in oil prices. The RBI kept the repo rate steady and lowered inflation forecasts, signaling no immediate rate hikes.
Lower oil prices, now near $82 a barrel, ease inflation pressures. This supports currency stability and reduces import costs, which is crucial for India as the third largest oil consumer globally. In the interest rate derivatives market, 1 year overnight index swap rates ended at 5.77%, with 2 year and 5 year rates at 5.94 and 6.26% respectively, reflecting market confidence in the RBI's cautious approach amid ample liquidity and subdued inflation.
Here's another significant update. ICICI Bank and Axis Bank are each raising 300 million US dollars through dollar bonds, with coupons near 5.35%, closing next week via private placement. ICICI's bonds have a 5 year term, while Axis is reissuing bonds maturing in June 2031. This return to the dollar market shows strong demand for Indian private banks' debt, using the Reserve Bank of India's hedging facility at 1.5% per annum, cuts their borrowing costs significantly, making these issuances more attractive for investors and the banks alike.
Now let's discuss another important development. Nielsen is acquiring Double Verify for an all-cash deal valued at approximately $2,150,000,000, paying $13.60 per share, a 30% premium over its recent average price. This acquisition aligns with Nielsen's strategy to build a $4 billion media intelligence platform, combining audience measurement with advanced digital advertising verification.
Double Verify's expertise in viewability and invalid traffic detection will complement Nielsen's reach across linear TV, connected TV, social media, and AI driven advertising workflows. Expected to close by the first quarter of 2027, the deal is financed by committed debt from Barclays, Bank of America Securities, Citi, plus equity, and cash reserves, enhancing Nielsen's innovation capabilities.
Let's look at another key development. The Lok Sabha passed a bill enabling banks and payment service providers to charge fees on unified payments interface transactions, removing the previous legal ban on merchant discount rate fees for digital payments. This change responds to surging UPI volumes and the need to fund payment infrastructure, but fees will only apply to merchants, not end users, as decided by the National Payments Corporation of India Committee.
The bill also extends income tax exemptions until the financial year 2040 to 41 for foreign companies manufacturing electronics in India, aiming to boost local production and global supply chain integration. This move strengthens India's electronics sector by encouraging contract manufacturing of devices like mobile phones and laptops, supporting the government's broader industrial growth strategy.